Okay. So, you tell me what is distribution tax? What is distribution tax? Yeah, mostly dividend. So it is a tax on any kinds of distribution. Okay. If you're distributing profits to another entity or your owner or etc., when you're distributing profits, then this tax would be applied. That's why it's called a distribution tax. Now you tell me, when you are paying distribution tax, you now think about the base logic which I told you. Where would the income be? When there is a distribution tax, who's paying the taxes? Where is the corresponding income for the purpose of ETR? Yeah, it's not tax on dividends alone, Sahil. It's tax on any kinds of profit distribution. So dividend is one kind of profit distribution. Okay. What is yeah? You tell me from the base logic I told you. Where would the profit lie? In which entity would the globe income stay? The profit corresponding to the distribution tax, where would it stay? The income will not be with the parent company. We're not talking about the distribution income. Okay, rather we are talking about the profits from which this would be distributed. So the profits are staying with the subsidiary, correct? It's a subsidiary's profit which is distributed onto the parent. So, and if you if you look at IFRS, you would see that dividend is not, even though it is distributed, as Melvin's doubt was, dividend is an income for the parent company. No, so you should come in parent company. Absolutely. See, Melvin, you have to understand that dividend is not included in the. It's not an item before profit before tax, or right. It's something which is a equity adjusted item. So if you take the P and L, that profits would stay in the in the subsidiaries books. Correct. The globe income would be in the subsidiaries books. The parent's income, which it gets, this dividend income, is in this exempt. Yes, parent getting this income would, in its books, it would be exempt. So this income effectively, or this profit effectively, would be in subsidiaries book. Did you understand that explanation? Is it logical? Melvin raised a valid point. There would be an income in the parents' books, but that income is exempt, Melvin. But in the subsidiaries book, what happens is, that is an below the line item. The dividend distribution is something as an equity adjustment rather than a line item in the P&L. So it will not be there in the P&L. So if we take the globe income from the P&L, this would be embedded into the subsidiaries books. Okay. Now, who's paying the taxes, distribution taxes? Who's paying the distribution taxes? It's normally the parent, guys. There would be a withholding that would be done before the dividend is issued, and that cutting, like this dividend distribution tax, would be remitted by the subsidiary to the government. But effectively, if let's say the dividend is 100, they will deduct 15% tax and they will collect 15 and only disburse 85. That's what happens. But there are jurisdictions where the subsidiary would pay the tax from its pockets also. They will issue the 100 dividend and 15 they will pay from the pocket also. But in this scenario, normally, if the parent is paying, parent normally pays the distribution tax. Like, there could be two, three systems parallelly, but if parent is paying, then what happens? If it's a, say, 100 is the dividend, I am collecting 15, 85 only I am reimbursing. In such a scenario, who's paying, in whose P&L would this current tax go and stay? It would be in the parent's books, right? In parent, it would be bank 85, tax 15 to dividend income 100. Yes or no? This would be the entry in the parent's books. So that 15 would be there as a current tax, or it would be a tax expense in parents' P&L. It will not be there in subsidiaries P&L. So that is being pushed down. Are you understanding what I'm saying? So to bring in parity, this is what is regarding distribution tax. Now let's see. So withholding tax on dividends paid from one constituent entity is another is allocated to the distributing entity, not the recipient. Okay, you understood why? Did you understand why? Why is this allocated to the recipient and not the recipient? Sorry, it is allocated to the distributing entity and not the recipient, because recipient would be having that current tax in its P&L. Distributing will not be having, but the income is in the distributing entity, not in the recipient. That dividend income would be exempt for the recipient. So that's why this tax is pushed down to the distributing entity. Okay. So what is the distribution relates to profits of the distributor. Allocating the withholding tax to the distributors cover taxes ensures tax is matched with the income. That is why they are absolutely doing it. So allocation mechanism. So let's say that the gross dividend is 1 million and the withholding tax 15% is 150,000. So net received by the recipient is 850. So in the recipient's books, financial account show a withholding expense of 150,000, correct, from distribution taxes. This would be pushed down to the distributing entity because that's where the profit is. This gross dividend would be an exempt income in their books. Okay. So global allocation would be this 150,000 is removed from the recipient's cover taxes and 150,000 is added to the distributor's cover taxes. You want more examples on that? Did you understand the rational logic? I'll be happy to do one more numerical if you want. Oh, fantastic. Okay. So this is distribution tax allocation. Now there is something called deemed distribution as well. Now what is deemed distribution is? Uh yeah, I'll take the board for that. Yeah. So what is deemed distribution? So distribution normally is something which is kind of like paid in cash, right? So what are the distributions which happens? Or like cash or kind. So there could be like distribution in terms of uh, dividends, as you said. There would be bonus shares, right? Then there would be other forms of distribution of accumulated profits, right? Now all this would be there. Now some people, what they do is, in order to kind of like be very smart with respect to taxes, what they do is, let's say there is a parent entity. Okay. So if there is a parent entity, I think we learned this in transfer pricing also. If there is a parent entity and there is a subsidiary, a parent entity, instead of injecting capital, or let's say that this parent entity is in UAE, the tax rate is, let's say, 9%. Okay. Subsidiary is in India, the tax rate is 35%. Okay. Now, some people, what they do is, if I inject more capital as equity, I will not get any tax deduction. So I will give apart from my equity, I will give a loan of, let's say, 5 million I'll give a loan of $5 million, and the subsidiary has to pay an interest of 10%, which is going to be 500,000 every. which is going to be 500K every year, let's assume. Okay. Now, the terms of the loan are that in terms of recoverability, it has the last charge on the subsidiaries assets. Okay, and sometimes what happens is interest need not be paid, or it is deferred for a long term. Only the accruals come in. Interest payment happens only after 5 years or so. These kinds of agreements are very common, right? Yes or no? So, what is the benefit for the subsidiary or as a group as a whole? It will get a tax deduction of it will get a tax deduction of 500K, which is their expense, into 35%. Right? That is a tax deduction that happens here, and tax payable by the parent is what? 500K into 9%. So effectively, they are having a tax advantage of 500K. They are having a tax advantage of uh, having a tax advantage of 500K into 26% is going to be a solid tax advantage for the group as a whole. Yes or no? Yeah. So these kind of arrangements, if there is happening between a parent and a subsidiary or related parties, they say that this particular thing, right, this 500K, this is not a interest charge. Rather, it is going to be a dividend. It is a deemed distribution of profits, not going to be treated as a interest deduction. Okay, it's not a debt, it's not interest, rather it is a distribution. So it would be there as an income in the parent, but it will not be an expense in subsidiary. Are you understanding? So that to kind of take away these anti avoidance rules, some domestic taxes would have a section on deemed distributions. Clear about the concept? There could be many. This is one example. This is one very common. This is called thin capitalization and all. Okay. So there would be a deemed, if you're interested, you can read about the concept of thin capitalization rules. There are many rules in thin capitalization, and UAE also has implemented a thin capitalization rule, which is, if you can remember from the domestic tax, there is one thin capitalization rule that UAE has, brought in. Yeah, interest deduction, but what rate? Interest is capped up to a maximum of dash amount of EBITDA. What is that dash amount? 30% of. Okay. So these are kind of interest capitalization rules. So these may be, some countries become very aggressive. They say that, okay, we will not be having any interest deduction. Rather, this will be treated only as a equity, or this would be as a dividend, not as an interest charge. Are you understanding what is deemed dividend? Okay. Now, in terms of deemed distribution, would there be a withholding when a subsidiary remits it to the parent? If these are in two different countries, this 500K going from subsidiary to parent, would there be withholding? Yes, there would be a withholding for deemed distribution. So what will you do in such a case? So that is deemed distribution. So as per new administrative guidance, the same rule that we learned about distribution taxes applies to deemed distributions. Now that would apply if ownership interest is treated as equity for tax purposes and the financial accounting purposes. Now, what they mean is this loan of 5 million, right? It is categorized for both. This only applies if this loan is categorized as equity in tax books and IFRS 9, or like whatever is the relevant standard. So basically both financial accounting and taxes kind of deem this as equity, then this would be selected for deemed distribution, or this would be this would be subjected to push down. The tax which is suffered by parent would be pushed down to the subsidiary. Are you understanding this? If it's a deemed dividend, you can argue that, sir, you told me that we are chasing profits and taxes. So there is no profits in the subsidiary. So this is not from the profits, rather, like it's not something very like to like the previous example. But yes, still, even though it is not from the profit and all, but if it's a deemed distribution, okay, the same treatment can apply. So if deemed distribution, what is happening, this 500k is removed from the interest portion, and P&L would have that much of profit bloated up, correct? And so that, and here also, if it's a deemed distribution, if it's a dividend, that would be now be exempted from tax. Yes or no? Exempted from globe. So in such a scenario, like the profits and the taxes, if there is taxes that is borne by parent, that has to be pushed on to subsidiary. This should only be done if it is treated as equity. This loan is treated as equity for both tax and IFRS purposes, not just tax purposes. Okay. Otherwise, you should not push down. Is that clear? The concept of deemed dividends. So this is one example. Don't think that it's always the loan. There could be like, India has a lot of deemed dividend provisions. 222E is a deemed dividend provision. So you can check this out. This is what it is. But, there are a lot of deemed dividend provisions. So deemed distribution provision, sorry. So you can check that out. But this is the whole rationale of it. Shall we move on? Okay, so if you there is deemed distribution, if the if it ownership interest is treated as equity for tax purposes and the financial accounting purposes, then the tax is allocated to the distributor. Now, what is the impact on ETR? Impact on ETR is that cover taxes increase for the distributors. So cover taxes will increase here. ETR increases here. Top up tax exposure decreases, absolutely, but don't think that this is a plus point. If you take this example, you will understand that this is a negative point. But for the recipient, what happens, the cover taxes decreases, dividend is likely excluded under 3.2.1, dividend is excluded, and net effect is neutral, both numerator and denominator reduced. But in reality, what happens is, like, since my ETR goes down, I will be having a problem, right? Since I am the low tax jurisdiction, I may have to. So this is the distribution tax allocation. Any doubts? We'll move on if you say yes or give me a shout. Yes. So this doesn't apply if it is treated as an NCL. What is NCL? Non-current liability. Yeah, absolutely. So what they say is it should be treated as a deemed equity only. It is not a loan. The nature of it should be treated as an equity for both, IFRS as well as tax purposes. Tax, we know that it's a deemed distribution, but the ownership interest should be treated as equity also. Then only this will apply. Otherwise, it will not. Okay. Reason is, if it is a non-current liability as per accounting books, then what happens is, for the distributor, it becomes an income which will not be exempt, right? Then the income would be here. If it is treated as equity and if it is treated, then that equity income is exempt. So this tax can be pushed out to a subsidiary because income is here. But if it is if the treatment is not right, then they are not taking the risk. Getting it? Okay. So let's move on and let's understand cross crediting systems. Okay, so this is something new which has come, and it needs a very good background. Now, what is a cross crediting system? Let's understand what is a cross crediting system. So, let's say that I am in, let's say this is the parent company in UK. Okay. Now, let's assume for a second that we have two subsidiaries. Okay, I have two subsidiaries. One subsidiary in, let's say, India. Okay, one subsidiary in India and one subsidiary I have in Cayman Islands. Or let's say UAE. For simplicity sake, let's say UAE. Okay. So this is not a subsidiary, sorry. This is, let's say it is a P. Okay, I have an India PE as well as a UAE PE. Okay, now let's assume for a second that the total income that India is making is $100. Okay, so and let's say there is a 30 or let's say there is a 40% withholding because it's a foreign company. So what would be the tax paid in India? $40. Correct. Now let's come to UAE. UAE also, let's say, that has $100 of income. Okay. And there is, let's assume for a moment that there is 5% withholding. Okay. So tax paid in UAE is $5. Okay. Now, normally, how would the credit system work? Now, let's say that, India is charging this income would be consolidated here also. And let's assume that this company has a tax rate of 25% in UK. Okay. Now, how will the credit system work? Normal credit system, how will it work? In UK, with respect to India, they will see that what is the tax paid? 40, right? For the same income, what is the tax payable in UK? 25. Yes or no? So, what is my maximum amount of credit I will get? See, how much of credit I will get in UK? 15. Why would I get 15? I'll get only 25. It's minimum of 25, or who said 15? Anyways, see, it would be always our tax rate or tax paid, whichever is minimum, right? Normal credit, tax credit network, right? So what is the credit I will get in UK for this tax? It would be 25 credit, right? And here, how much is the credit that I will get? I paid 5, but if the same income is taxed here, I will pay 25. So how much is the credit I will get for UAEP? How much is the credit I'll get for UAE? Absolutely 5 because it's 25 or 5, whichever is lower. Correct. So I will get 5 credit. So if I take my income here in UK, so the total tax payable, total income is, how much from both the PEs? It is 100 plus 100, 200. Correct. Tax on income is 25, $200 dollars into 25% that I have to pay in my home country, and that is going to be how much? I think it is 50, right? Yeah. Now, what is the credit I will get? Credit I will receive from India is going to be 25. Yes. And the credit I will receive from UAE is going to be 5. So, what would be the total tax I will be paying? What will be the total tax I will be paying in UK for my PE related income? It is going to be 20. 50 minus 25 minus 5. So 50 minus 30, it is going to be 20 I will have to pay. This is what we call as normal credit system. Correct? This is what we use in here also. Normal credit system. Now, what is cross crediting system? Okay, what is cross crediting system? Cross crediting system is there in few countries. So what happens in cross crediting system is, in let's say my total income, so cross crediting system I will do differently. So let's say my total income is how much from PE is $200. Yes. And I will have to really see what is the amount of taxes that I am paying. So tax paid in India is how much? 40. And tax paid in UAE is 5. Right. So what is the tax which I would have paid in UK for the same income? It is going to be 25. Yes. And tax paid for this income in is 25. Now, here I have paid an excess tax of how much? I paid an excess tax of 15. And here I have to pay shortfall of 20. Right. Now, what happens in a credit cross credit system is this excess payment in India, right? That I can use to kind of pay off this shortfall of 20 in UAE. So, effectively, you would be paying a tax of total tax payment that you would be doing is 20 minus excess paid in India. So, I will pay 5 to pay. Are you understanding cross credit system? This is normal credit. Okay, in cross credit, what happens is whatever is the excess you paid with respect to one jurisdiction, that is allowed as a credit to pay the shortfall of some other jurisdiction. In a normal credit system, that is not possible. So you say the total tax payment that I make is not 20 to pay in UK. This is actually 20 to pay in UK plus 40 to pay in India plus 5 in UAE. Right? The total tax I'm actually paying is 20 plus 40, 60 plus 5, 65. Yes or no? But here, so it is totally 65. But in this cross crediting system, 5 I will pay in UK, 40 I'll pay in India, and 5 in UAE. So how much am I actually paying? How much am I actually paying? 45 plus 5 is 50. So this is normal credit, and this is cross credit system. Cross credit system basically ensures that the total tax you pay is equal to the tax rate in UK. So 50 divided by 200, you see that it is 25%. This is cross crediting system. If you paid excess in another country, that would be used to eliminate the shortfall in another country. Is it clear, this cross crediting system? Any doubts? This is cross crediting system. Did you understand cross crediting system? Instead of objectively looking at one on one, we are looking at, if there is a short excess paid here, then I will use it as a credit to pay here. Ultimately, what I'm trying to say is, in a cross crediting system, it is going to be the tax rate in UK, or the tax paid here, whichever is going to be higher, I will kind of take instead of taking lower. Getting it? Cross crediting system. So they are basically not just doing unilateral credit, but they are doing cross credit also. Okay. I don't get any responses. I don't know if okay. So this is cross crediting system. So in terms of cross crediting system, we have to see how the push down happens. Now this is a PE. Remember, PE has to push down the tax, right? Yes or no? Because the profits are in here, not here. So this would be pushed down to the P, correct? Now, in this scenario, how much is the tax that is paid in UK? It's 5, right? So how much of this would be pushed out to each of them? How will you decide? You understand the problem that is happening here because of cross credit system? If it was total 20, then it's fine. But if it is 5, how do you allocate between those two entities? How much of tax will be to India? How much of tax to UAE? That becomes a problem if you take cross credits also. Okay? In this scenario, you tell me, where would the tax be pushed out? Because I am not paying the full tax, rather I am paying a small amount. So in such a scenario, where do I push down the tax to? To India or to UAE? So what they are saying is, push down to the entity where there is a shortfall. Who is using the excess tax credit? You have to push it down there. Okay, India will not get any push downs because India is already taxed at 40, but UAE is shortly taxed, and that 5 is what was paid by that 5 is only pertaining to UAE and not India. So push down that 5 from UK to UAE. Are you getting it? This is cross crediting system. You have to see who is having the shortfall and push it down. If there are multiple entities with the shortfall, then allocate on terms of revenue or income that is being attributed. Okay. Now let's see. So cross crediting systems for jurisdictions with foreign tax credit systems allowing cross crediting. Step one: determine the foreign source income. Okay, so determine the foreign source income. Determine the income. Here, what is the income? It is 200. Correct. Determine the income for as foreign source under domestic. Calculate tax on foreign source income. Apply. So you have to calculate tax on foreign source income, which is 50. Then determine the excess FTC limitation. Compare FTC allowed versus used. So how is the excess that I have to pay? I have to pay excess of 5, right? In the cross crediting system. Now, allocate residual tax, push down based on entity by entity income shares. So basically, this 5 will be pushed down to the person who's in a shortfall. And if there are more people with shortfalls, which India's high tax is being used to pay, then allocate on that residual tax on the basis of the shortfall. Okay. Is that clear? Cross crediting system? This example? Basically saying like yes, PE has to push down the tax, but India does not get anything because India has already paid. Its excess was used to take care of UAE also. So this 5 is not pertaining to India. This is pertaining to UAE. This 5, sorry, not that is credit. This 5 is pertaining to UAE. Are you getting? Okay, so that is cross crediting system. Now, deferred tax allocations. So we have seen that covered tax allocations are there, but there should be deferred tax allocation also, right? If there is deferred tax in the, let's say in this example itself, if there is parent company in UK and because of, for the PE's profits, there is some deferred tax items that is remaining in its tax expense, then that also has to be pushed down. Okay, deferred tax items that is available as a result of attribution is also something that has to be pushed down. So let's see. So there is a four-step formula for deferred taxes pushed down to the CFC is also okay. Identify the deferred tax attribute to CFC income. What is the deferred tax attribute? Determine the CFC share of deferred tax. Calculate whatever is the deferred tax you're pushing down, you have to put it under, apply the 15% cap and then push down. You can't take the tax rate that is there in the home country jurisdiction. You have to apply the 15% rate and then also apply the passive income limitation and then push down. Are you getting it? Whatever is the deferred taxes, you apply two things: 15% cap and passive income limitation, and then push it down. So even though this is the formula, like what is happening is this is something that is very easy to do, but practically identifying the deferred tax attributable to the particular CFC or a PE is what is going to be hard practically. Okay, so identify the deferred tax attributes, pass the push it all that also push down after keeping a 15% cap and the passive income limitation. What is the passive income limitation we discussed yesterday? If this deferred tax is due to a passive income like rent or shares or dividend or etc., then you have to see the minimum of tax, the deferred tax, and the top up tax of the jurisdiction to which you are pushed on. Whichever is lower will only go forward. Okay. If you don't want your deferred tax to be pushed on, if you say that, okay, this allocation identifying the deferred taxes attributable to CFC income or PE income is going to be extremely difficult, I don't want to do it, then you can take an option not to do it also. You can keep it with your parent. So MNE can elect to exclude deferred tax allocations for a jurisdiction and the election is made on a jurisdictional basis. So per jurisdiction, I can make the election, and deferred tax is excluded from both CE receiving the allocation and parent entity making. That deferred tax would be completely taken away from your globe allocation fully. You can take this election if you don't want to go through the compliance rabbit hole. Yes, no, okay. So this simplifies compliance, but it will affect the ETR because deferred tax itself is taken out. Okay. So let's take a moment here. I see that people are sleeping. So let's take a moment here to recap. What is happening? What exactly are we doing in the whole thing? So we learned that what is the basic principle? What is the basic principle of this chapter? What is the basic principle of this chapter? Follow where the tax follows where the income, globe income, right? So where is the globe income? That is where the tax follows. Then only we can effectively calculate the ETR. Yes. So this is the basic principle. Now, what kind of things are to be allocated? First thing is, my friends, PE income, right? So if there is an income in the head office's books, then that income is pushed down to PE. And one thing is that tax on PE pushed down to PE. So that tax is pushed down. Correct. This income and tax is removed from HO. And then if it is a lost case, then there is reverse push down. Is it clear? This is what we discussed first regarding PE. Yes. So that we are okay with this principle, which is the second one which we discussed. Second principle we discussed is CFC pushdowns. So tax is push to subsidiary because that is where the tax is pushed to the subsidiary because that is where the income is. But you have to apply the passive income limitation. Okay. Then we learned about distribution taxes. No, before that we learned hybrid entity. What is hybrid entity? Hybrid entity means it is a flow through entity. It is regarded as a flow through entity in at least one jurisdiction. Right? So if it is a flow through entity, oh my god, what just happened? We were discussing it. Yeah. It should be a flow through entity in at least one jurisdiction, in either in its own jurisdiction or in its owner's jurisdiction. Then it is a hybrid entity. Now, if it is transparent in both the entities, then it is a fully transparent entity. That means the owner will only pay the tax. This is not a separate CE. So leave it. There is no allocation which has to be done by the owner. But if it is opaque in owner's jurisdiction but transparent in its own jurisdiction, then there would be an allocation. But if it's a reverse hybrid, this is what is a hybrid entity. It is a flow through in its own jurisdiction but opaque in the owner's jurisdiction. Then normally the owner shall pay, and that will be allocated to the this entity. But if it is a reverse hybrid, that it is opaque in its jurisdiction and transparent in the owner's jurisdiction, then there won't be any allocation, because there is taxes already paid at this stage. Are you getting it? This is hybrid entity allocation. Okay. So you have to be careful for hybrid entities. Who's hybrid? Transparent in own jurisdiction and opaque in parent jurisdiction. So this kind of things we will push down. Okay. Then what did we learn? We learned distribution taxes. Then we learned distribution tax. Distribution tax should be pushed down. You know the reason why. It is an exempt income there. Push down to distributing entity. If there is a withholding, it will not be kept with the parent, because the income is there in the distributing entity. In the parent entity, it would be dividend income would be exempt. So it makes sense to push it down to the entity where there is actual income allocated. This is distribution tax. Then what did we study? Then there were something called cross credit systems. Cross credit systems allocate to the entity with the shortfall. Then there are allocations of deferred tax allocation. This is after, after you have to allocate deferred tax also to CFC, if there is a deferred tax portion, after 15% cap and after passive income limitation. I think this is the whole summary of what we were discussing the whole day. Did we miss something? Don't think so. Eight, right? One, two, three, four, five, six only I have. Distribution tax allocation, hybrid entity allocation, passive income limitation, CFC push down. Yeah, I think we are done. Okay. So in distribution tax, there is deemed distribution also. Deemed distribution should only be done. So there is something called deemed distribution also, which is to be allocated only if both the tax and accounting standards treat the holding as equity. Yes. Is it clear now? This is actually quite simple. Only thing is there are a lot of tax concepts that we have to learn, especially from an international point of view. So that's the only problem I see. Other than that, it is all fine. Let's do one question now. Exam grade question for tax calculation, tax pushdown. Yeah, yeah, deferred tax 5-year election also. Okay. Now let's do one question. I will not be doing it. You guys will be doing it. So the entity structure is like this. AR Holdings UK. UK is the ultimate parent entity. It has a subsidiary in Germany, which it holds 100%. It has a PE in Belgium, German branch in Belgium. Okay, I think that's a typo. Basically, let's say that it's a PE in Germany. Okay, this company, the UP has a PE in Germany, and it has a subsidiary in Singapore, which it holds 100%, and it has a subsidiary in Ireland, which has 100%. It pays dividend to the UK parent. So now tell me how much is the tax that will be allocated from the UPE to subsidiaries or vice versa? How was it go? So let's do this together. Okay, in the interest of time. So I'll just open an Excel sheet. Now, how you guys are using Aptos? Okay, so UK tax. So we are now allocating the taxes, right? So we'll take each company. So let's say Germany. Okay, Germany does not have any problem. So there is no, it's not a CFC regime. So subsidiaries normally the push down will happen when it's a CFC, right? I don't think Germany is a CFC. It's not mentioned. So let's go to the Belgium P. Okay. So UK tax on Belgian PE income is 180,000. So branch income taxed in UK. Okay. So let's see. So step one is PE allocations. Okay. Now, now let me see. So what is the tax paid in UK for PE? 180,000, right? This is tax paid. What should I do with it? What should I do? Absolutely push down to PE. That's it. So you have to understand that this is PE income and it's profit. It's not a loss. So push it down. And we are not given any instances where it says it was a loss prior. So let's push it down. So the amount of the amount of current taxes removed from UK UPE is 180,000. So I will color this so that we can kind of, so let's give this color for UK, and this amount is being taken out, and the amount added to Belgium PE is simple. Now, what is the next step? There is a CFC charge on Singapore. So the Singapore, which the UP holds 100%, is a CFC. So let's see CFC allocations. Why is it coming as Aptos? Okay. Step 2 is CFC charge on Singapore. So what is the CFC tax which UK has paid? It is 320,000, right? 320,000 is what is paid. Now they have given additional thing. It is a passive IP income. So it's a passive income limitation. Okay. Now Singapore passive income is how much? 1.8 million. And Singapore local tax is 150 million on 4 million global. Okay. So what is the tax paid? 320,000. What is the passive income limitation? How do you calculate passive income limitation? So we have to see what is the top up tax in. So we have to see what is the top up tax in Singapore. So what is the total income, globe income in Singapore? They have given it's 4 million, right? Total globe income is 4 million and total tax paid is 150,000. So what is the ETR? 150 divided by 4 million, they have an ETR of around roughly 4%, which is 3.75% is what their ETR is. Yes. So in that case, what is the top up tax? Top up tax is going to be 15% minus. So it's going to be 11.25%. Are you clear how I calculated the top up tax? So what is a passive income limitation that I can bring in? It's either lower of tax paid in UK, which is 320,000, or it's already written here, or top up tax percentage into passive income. So they have given here that the passive income is 1.8 million. Okay. So that is going to be 1.8 million into this top up tax. So it is only 205, 200. So we will take the minimum of both of them. And what is the minimum of both? It is this guy, right? So the tax push down to Singapore CFC is going to be this. Yeah. So it's going to be negative here. And tax increase in Singapore CFC is going to be. Did you get it? Like, how the passive income and CFC allocations are made? Yeah, pretty simple. What is the tax paid or lower of tax paid in UK, or the top up tax into that passive income, whichever is lower would only be pushed down. Remaining will stay in UK. Okay. Now there is one more thing I see. Step 3, there is a withholding on Irish dividend of 75,000. So 15% withholding on 500k dividend. So there is a withholding. Okay, there is a distribution tax. So step 2 is PE allocation. Now step 3 is distribution tax allocation. So let's do this distribution tax allocation. What is the distribution tax in the 15% withholding on 500k dividend? So they have, the Irish company has paid some dividend, and there was a withholding of 15%. Now this is a distribution tax. Now what I do, I push it down to the recipient. So tax push down to Irish subsidiary. How much do I push down? The whole thing I will push down. 75,000 I will push down, and this I will mark, and tax increase in UK is going to be, sorry, tax increase in Ireland is going to be 75. Now let's see what is the global ETR that we are kind of doing. Did they give any income level? No, they not. No, they're not. So we are only have the income of this, this guy. Okay, so let's see after push down what would be the tax. Okay, so tax paid in Singapore, already paid in Singapore is 150,000. Now there is a top up, tax push down of 200 and 500 total tax. So 352,000. So ETR is going to be 4 million, which is their income. So it is 352 divided by 400,000. So its ETR has now improved. You see, it was normally 375. It has improved to 881. So what is the new top up tax that they have to pay in Singapore? See, from 11, see from 11, it has come down to 6 because of the push down. Yeah, in Singapore, because normally it was only 150,000 divided by 4 million. Now it is 150 plus 202 500, 352 divided by 4 million. You see the top up tax level has come down because of the push down. Is this clear how to do questions on PE allocation? Yeah. So just look into it, and these are the summary that you have to kind of keep it as notes all the time, because there are a lot of permutations and combinations. If you make notes like these and kind of like keep it with you, it's pretty easy to revise and get back the in memory what we have to do. Okay, guys. So with that, let's close for the day, and I think we will meet in the evening also if time permits. Okay. See you.